In the previous lesson, you learned the ins and outs of the profit and loss statement. Now, we will look at the balance sheet. The balance sheet is a statement of the company's assets, liabilities, and equity from the beginning of the business up to a particular point in time. These terms are not as straightforward as income and expenses, so let's define each term. In life, an asset is a useful or valuable thing or trait. In business, it means exactly the same thing. I don't want to spend time covering each type of asset in detail, but the important fact to remember is that whether an asset is cash in the bank or an item such as a $3,000 conference room table, assets contribute to the value of your company because, if need be, that conference room table could be sold for a notable amount of cash. A balance sheet also includes liabilities. Liabilities are money you owe, such as credit card balance or loans you've taken from a creditor. Equity. Equity is the last section of the balance sheet. Equity represents the worth of the business according to your accounting records. It includes profits from prior years as well as the current year, profits and any money the owner has invested in the company. For companies with stockholders, it also captures the value of stockholders' equity. Let's look at a sample company and its balance sheet. The company is Rockcastle Construction, and we are reviewing the balance sheet up through the end of December for our fictitious year. As discussed, the balance sheet has three elements: assets, liabilities, and equity. Let's scrutinize the balance sheet at a more detailed level. Assets will always be at the top of the balance sheet. Remember, this includes items such as money you have in the bank, as well as fixed assets. In the example of Rockcastle Construction, you can see they have checking and savings and petty cash, as well as accounts receivables owed to them from clients who have not yet paid their bill. They also have fixed assets, everything from furniture, vehicles, buildings, construction equipment, and land. The next main category on the balance sheet is liabilities. In the case of Rockcastle Construction, this includes bills owed to vendors, as well as credit card debt and some payroll wages and state taxes that have not yet been paid. They also have long-term liabilities, such as auto payments and other various loans that extend beyond the current year. The last main category is equity. As you can see, Rockcastle Construction has stockholder equity. This is because they are a corporation. As a corporation, they have stockholder equity account. If your business is a partnership, you will have separate equity accounts for each partner. If you're a sole proprietor, then you will have an equity account for you as the sole proprietor. Usually one that shows your owner contributions or investments and another one for owner withdrawals. You may have heard of the accounting formula, assets equals liabilities plus equity. Well, you can see that here on the balance sheet, Rockcastle Construction's assets of $635,033.93 equals its liabilities plus equity. The balance sheet is the most important accounting document for displaying the value of your business at any given time, if it's accurate. Now that you understand the elements of the balance sheet, let's use the information to help us make a business decision. Rockcastle Construction is considering getting a business loan. They want to know, before they talk to the lender, what their chances are for being approved for the loan. They've been advised to check their debt-to-equity ratio. Debt-to-equity ratio compares your company's total debt to its equity. It reveals how much of the company's current financing comes from creditors versus investors, investors being people who typically have ownership in the company. In order to calculate this ratio, you want to take your total liabilities. In the scenario of Rockcastle Construction, that is $420,443, rounded to the nearest dollar, and divide that number by your total equity. For Rockcastle Construction, that is $214,591. Rockcastle Construction's debt-to-equity ratio is 1.96. But what does this mean? It means that more of the company's current financing is from creditors than investors. A lower debt-to-equity ratio implies a more financially stable business. An average small company that is healthy will have a debt-to-equity ratio of 1.5 or less. Borrowing more money from the bank will put the Rockcastle Construction's debt-to-equity ratio well over 2. Therefore, before they go back to the bank to request a loan, they should consider paying off existing debt or find a way to increase cash without borrowing. Next, we will look at the cash flow statement.